Andrew Stafford, president of Prevail. I'm here with Dylan Sayles, one of our investment advisory committee members. Dylan, let's talk a little bit about what we'll call the market scorecard.
Yeah.
What are some of the things that we monitor and look at as we're managing money?
Yeah, when looking at the scorecard, it's almost viewed as like a stoplight,
Yep.
right? Red,
Red,
yellow,
yellow,
green, right? Where are we going?
course.
Do we go fast? Do we put our foot on the gas, or do we slow down and put our foot on the brake? What we look at on that scorecard is inflation, right? What are inflation numbers? What's real wage growth going, right? Where are our bond yields? What's the consumer sentiment? Some of the things that we've talked through already, but then pairing that with unemployment, right? How's the job economy? How are labor reports, right? And then jobless claims, GDP growth, which I already hit on. So
those are high-level things.
that
Then we
we're
dive
looking at.
down from there
That's
and really
right.
look at what is driving a lot of those
That's
figures.
exactly
And
it.
there's a lot of mixed signals that are happening. And again, we've talked a lot about April was a screaming month, and when you look at money managers, it was risk on. I think
That's right.
some of our reporting, you had almost all cash deployment was going into portfolios. Now we're hitting May. You have the old saying on Wall Street, sell in May and go away.
Yeah,
right?
yeah.
But we've talked about how there's some cracks and some things that maybe that's not traditional. But what I really think that is important right now as we look at this kind of May volatility is repositioning of portfolios. And the volatility a lot of times is fearful to investors, but the way we look at it is it's also opportunistic because there's a whole slew of potential long-term holdings that are incredible that we just thought were priced out of the market. And some of those repriced to levels where we can enter and we feel good about buying those positions.
Yeah.
You're in essence getting it at a discount.
Yeah.
So as you think about what are some of these key things, I look at this and we're kind of half on our key indicators. Half are red, half are green, and we have a couple are in the middle. So when we see that, what are some of the things that we do as an investment advisory committee?
Well, I think most people would look at it and say half red, half green, and they just kind of sit there and like, where do we go? What do we do? And they do nothing, right? Operate with caution. But we see this as an opportunity. So we're saying, okay, where can we go into? And why are these factors changing? So when we look at, the unemployment rate, it's moving up to 4.3%, but if we look over the last 30 years, it's been 5.5%, right?
On average.
On average.
Yeah.
So what I think that translates to is, you have a lot of boomers that are leaving the market, leaving the job cycle, right? And then you have a lot of AI that's creating efficiencies. So what we're looking at is, okay, where are these long-term efficiencies going to be created, and where can we go in at a discount, right? Because there's times where
the labor market needs AI.
That's right.
And a lot of people get fearful of it, and a lot of people think, oh, I'm going to lose my job over AI. What I think is important for people to understand is the baby boomer generation that is retiring was one of our largest demographics that we had in our curve of population.
Yeah.
And they're leaving the market so fast. I think the last baby boomer is supposed to be retired by 2030 or something like that. And the generation behind them, not only does it not have the same knowledge that generation had, but it's just not as big.
That's right. Yeah.
And so if we don't get some efficiencies and we don't get the ability for one individual in the workforce to do 1.5 or 1.25 of the job that they used to be able to do, we'll call that efficiency, then we're going to be in trouble and it'll stifle growth.
That's right.
So I think the combination of AI as well as the retiring labor force is really important to mirror together. Now, what we have to be cautious of is the spending on AI and the CapEx, because at some point in time, all of these companies that have mass spending have to get ROI, return on investment.
That's right. That's right. And that pulls us back to our market scorecard.
That's right.
Of, how do the consumers feel with all this debt coming out and spending, and how do they feel about it? Are they going to continue to spend? Because businesses are spending, but consumers aren't as much anymore.
Yeah, so to break it down, I think where we were coming off exuberance in April, which always happens, right? Not in April, but when we have exuberance, what happens is a consolidation generally follows, and then the markets can run. I think the key indicator right now is we're proceeding with caution.
That's right.
And we're really watching what does the energy and the bond yields look like, and when do those start to pull down, which I think will release the markets.
Yeah, and there, oftentimes in our conversations in our committee, we're talking about, hey, we really like this company. We're not willing to buy it at the price it's at right now. So we're continuing to proceed with caution to make sure we still have good entry points and being nimble enough to be able to rotate as the market rotates.
It's an interesting time. If you'd like to learn more, check us out at prevailiws.com.